Hello, and welcome to another episode of the Market Pulse series. My name is Rufas Kamau, Markets Analyst at FX Pesa. So, once you join in, and say hi, the live comment section, and these will confirm that everything is working just fine. So, as we all know, today is Thursday, so we'll be looking at what's currently happening this week. And at the same time, look at key price levels in the markets. And on top of that, we'll be looking at what we are expecting in the market over the next 1 week. So for a majority of the daily market updates, we have moved them to the morning sessions. So we are having the market snapshot series happening every day, Monday to Thursday, from 11 a.m. It's usually very short, between 10 and 15 minutes. And you can find it on the FX Pesa YouTube channel. So hello, Max. Hello, Apollo. Thank you guys for your responses. I appreciate you. And let's get this going. So first things first, I would like to look at the economic calendar. So there is quite a lot that is happening in the economic calendar. Just a moment. So we have been following all these data that the US has been releasing in a bid to try and understand the direction the Fed is taking. And once we understand the direction the Fed is taking, then we can position ourselves in that direction. Or in simple terms, we don't fight the Fed, we follow the direction of the Fed. So markets are forward-looking. So any intelligent investor out there is looking to place their positions ahead of the Fed decision. So as we all know, in the previous meeting, the Fed went for a 25 basis point hike. And now there's an argument or an expectation that this could change and we could be seeing the Fed going for a much stronger rate hike. And in that case, we are talking about either 25 basis points or 50 basis points. So there is a potential we could get back to 50 basis points, especially considering the data that we are currently seeing happening in the US economy. So one key thing this week, we had the S&P data, S&P Global Manufacturing and Services PMI data. So if I share my screen, you will notice that this has been the dominant news for the week. So we started with Australia, flash manufacturing, flash services. We saw it happening for Japan, the Eurozone, the UK, as well as the US. So all this data comes from one organization, that is SP Global. So I'll be showing you a brief highlight of what happens from those data points. So number one, the list, I'll be looking at Kenya. So with Kenya, this is data prepared by Stanbic Bank, basically doing a survey of about 400 businesses in Kenya to try to understand the performance of the private sector. So clearly, you can see that the PMI went to an 11-month high in January, basically moving 52.0, and 52.0 is usually indicative of expansion. So whenever there is a contraction, the often or the most common thing that we see is the number reading below 50. If it's above 50, then this is generally considered as expansion. So for Kenya, the data has been improving month over month for 3 consecutive months, and now we are seeing this reading at 52.0 in January, up from 51.6. So when we move to the major economies that we focus on in our trading, we'll start with Australia. You can see there was a big jump, moving to 49.2 compared to 48.5 a month earlier. This is a big improvement, largely approaching expansion. So it's still contractionary since it's not 50.0. However, for manufacturing, we saw this moving to 50.1 from 50 the previous reading, indicating that manufacturing conditions in Australia are expanding. So it's a common trend happening across the board. So you can see that for Japan, it was also an expansion. Composite output, which basically provides services and manufacturing, here at 50.7, same case as January 50.7. So flash services business activity index, in this case, went up to 53.6, indicating an improving economy in Japan, whereas manufacturing was lagging, which went down to 44.9 compared to 47.2. in the previous month. So this basically means that the manufacturing conditions in Japan are worsening, but the services sector is pretty strong. So moving on, looking at the Eurozone, the PMI came out at 52.3 compared to 50.8. Sorry, this is a 52.3 in January, which is a 9-month high. Services 53.0 compared to 50.0. So also an improvement. So 52 by 50, 53 by 50. All these are improvements. Whereas manufacturing also went to an expansion territory around 50.4 compared to 14.9. So for the Eurozone flash manufacturing PMI, this was the worst performing at 48.5 compared to 48.8. So you can see that there is an expansion in services across board, whereas manufacturing is largely quiet or even worsening, which is the case for Eurozone as well as Japan. So now when we move to the US, you can see there was a good improvement. This was at 50.2 versus 46.8. And this is the composite output. For the services sector, it was really good at 50.5 compared to the previous reading of 46.8. So these are an 8-month high. Then for manufacturing index, it was 48.4, a slight improvement from 46.9. And at the same time, this is indicative of contraction within the manufacturing sector because it's below 50.0. So manufacturing PMI, remember this is output and this is the PMI. So 7.8 versus 46.9 previous month, basically indicating a slight improvement, yet below 50. So across board, what we are seeing with this data is pretty simple. Economies are expanding really well. That is major in the West. And this is mostly as a result of optimism within these economies and also continued strength of the consumer, which is creating higher sales in the services sector. So with this in mind, when you remember the jobs data that we saw for the US in the previous month, it was a big surprise where we saw jobs jumping all the way up to over 500K jobs versus an expectation of about 200. In Canada, over 100K jobs, actually over 150K jobs, compared to an expectation of 15K jobs, basically indicating that the labor conditions are very tight, and this is indicative of a very healthy economy. So it's almost as if the economies are enjoying the high inflation environment and are continuing to strengthen. So as a result of this improvement, we're also seeing the inflationary pressures moving up higher. So with the inflationary pressures getting higher, then the central banks are mandated to move this inflation back to the target. So for a majority of the countries in the West, including the US, the target is 2%. So this basically implies that they are looking to continue hiking interest rates, pushing them even higher in order to achieve their target goal. And this is the biggest problems that central banks are facing right now. So this majorly includes the US central banks or the Fed, the ECB or the European Central Bank, the Bank of England, same thing as the Central Bank of Kenya. All of them are trying to tackle this big problem of inflation. So if you look at housing, I think housing is also facing some challenges. So if you look at the US 30-year fixed US mortgage rate, this has been moving further back downwards from the highs that we saw back in 1975. So you can see the continued movement downwards. And as the economies continued expanding with the higher, with the higher quantitative easing and lower interest rates, then the overall trend was moving all the way down till we saw a rate around 2.4-2.5% last year. So from then, since the Fed became very aggressive hiking interest rates, you can see the mortgage rates from around 2.3%, around 3% all the way up to 6.8%. So this trend is expected to continue, and as housing becomes more and more expensive, then we'll be seeing more liquidity get pulled out of the market. So the US consumer is currently very weak, or in terms of our debt, we have seen record debt rising. So I want us to focus on this particular chart, and this is a consumer credit outstanding for the US. So as you can see, the dates from 1995 all the way to 2022, then it's a very clear trend that the debt outstanding is getting higher and higher. And of course, this is normal as the consumer number increases or the population of the US increases, then the whole outstanding debt is expected to continue rising. But then when you compare these with the credit card interest rate, then you notice that the interest rate has been significantly low. Then once it started rising around 2015, when all the stood around this area, pulled back well when the interest rates were low during the COVID period. And then a very big spike happened last year when the Fed got very aggressive interest rates. So there's a large population of Americans with a lot of debt. So with this debt, then the interest rate was quite affordable at these levels of around 12.5%. And now this has shot really high. So currently at 16.25%, and this is not the most recent data, we are expecting that this interest rate will continue rising and people will have to pay more of their money to apologies. So I lost my signal for a while. So we're expecting that people in the US will be paying more of their income towards their debt, and they will be left less money to consume in the economy. And this could have far wide-reaching consequences, including a recession of the goods. So a recession will be largely expected when the cost of debt becomes significantly high for both consumer credit as well as for mortgage rates. So when it becomes unsustainable, then in this case, we're expecting people to resort to cutting their spending. And when expenditure goes down, then company revenues will be hit. And we will be seeing the stock market crash further down again. And this is the basis of the talk of recession that we have been discussing for the better part of this year. So with that in mind, I'll be looking at a couple of more charts. So this other one is the federal funds effective rate for the interest rate, and a very special rule called the Taylor rule, which basically estimates the level of interest rates that should be restrictive enough to calm inflation and put it towards the target of about 2%. So according to the Taylor rule, and this is shared from Lynn and Ben, is that if the Fed was to raise interest rates to a level of around 10%, then this would be significant pressure, push inflation back towards 2%. So the current rate is 4.75%. So this is significantly low. So it's basically implying that the Fed is not doing enough to fight inflation in the US. And since it's not doing enough, then inflationary pressure continues rising. And if it gets sticky, then things get a lot worse. So those are some of the challenges that we are facing. That is in terms of interpreting what the Fed is about to do. And the Fed is also looking at the same data, and it will be using this data in the next sitting in March. So some of the more data that we have seen this week includes the interest rate decision in New Zealand, where they basically hiked interest rates by 50 basis points to 4.75%. So this is in line with other central banks in the West to continue pushing these interest rates higher. And as a result, they expect that there will be less money in the economy and inflation will move towards target. So I think the Reserve Bank of New Zealand has the best explanation of what they expect. I think it's the most impressive website among these other central banks. So they explain how the OCR affects interest rates, why have interest rates gone up, they explain why they have done so, how will interest rates prices affect me. So this is a message to us, the citizens of New Zealand. So if you have a home loan or mortgage, they explain that it's going to get more expensive. If you are saving for your first home or for your retirement, then the interest that the bank will be paying you will be a little bit higher. Then how do high interest rates help bring down inflation? Clearly, by encouraging less spending in the economy, increasing exchange rate for the local exports, and also by reducing wages. So one of the data points that the Fed is looking forward to is to push the wages lower, or the growth in terms of wages to get lower. But then it's a very tricky situation, especially when you consider what's happening. So the rate of unemployment is at 44-year low in the US, currently at around 3.4%. So what this means is that the economy is expanding so well that it's creating sufficient jobs for everyone. And for companies that are looking to hire, they have had to increase wages in order to get new talent. On the other hand, for companies that already have employees, they have had to raise wages in order to retain those employees, because there is a much higher demand for employees than there is a supply of employees in the US. So as a result of these, wages keep on rising, and as long as we have more money and goods remain similarly the same, then you have excess money chasing fewer goods, which eventually causes inflation. So with that in mind, then we'll be expecting the Fed to get a bit more aggressive with the rate hikes, and to do this for longer in order to push inflation back down towards the 2% target. So also, we had monetary policy snapshots. I think I will be sharing these later in the group so that you can have a deep dive into the document. So demand in the New Zealand economy was robust in 2022. Economic growth has been supported by household spending and construction activity, strong government spending, and a swift recovery in international tourism since the border reopened. So these are economies that are largely experiencing strong growth after reopening from COVID. And with this strong growth, there is also very strong inflation, and inflation now becomes the #1 target. So in terms of jobs, I think they are at record levels. I think for New Zealand, it's about 3.4%. I think I saw that somewhere here. I think is the previous one. So the target for inflation, note that for New Zealand, it's a range between 1% and 3%, where the midpoint is 2%. So I'm trying to get the job, the unemployment level, somewhere around here, but it's a multi-year record, basically meaning that unemployment is really low. So with that in mind, then we'll be expecting these central banks to get even more aggressive. So once you understand these two monetary policies for the Reserve Bank of New Zealand and also for the US, they seem kind of similar. So when you're trading Forex, the idea is to look for one that has a huge divergence, and the obvious target remains the Bank of Japan. So the Bank of Japan has been maintaining interest rates at 0.1%, and at the same time, it has been doing what we call quantitative easing, or simply printing more money and using this money to buy bonds in the open market. And this is flooding the Japanese economy with cash. So despite inflation rate target, the Bank of Japan has continued with the same monetary policy, even despite having a new central bank governor. So as an obvious trade, now we look at pairing these currencies, New Zealand against the Japanese yen, and also US dollar against the Japanese yen. So the idea is that as long as one central bank continues hiking interest rates, their currency gets stronger, and the one that is maintaining interest rates at a negative 0.1%, then the currency gets weaker, especially when you add the fact that they are also doing quantitative easing. So there's also the factor of severe storms across Northern Ireland, which are expected to increase inflation and disrupt production in the near term and add to activity during the rebuild. So remember, whenever there's a cyclone, and it's a big one currently happening in New Zealand, it's basically affecting production. So as long as the production gets slower, that is, you have much fewer goods, and these fewer goods are being chased by an excess money in the economy, then inflation continues to rise, or basically the prices of those goods keeps on rising, and inflation becomes an even bigger problem. So now that we have looked at that, let's take a look at Envies, look at how some of these currencies are performing over this month of February. So jump right through Forex and look at performance here. So I want us to move to month to date. Month to date basically means the performance of a currency since the first of this month. So clearly, you can see all these currencies are compared against the US dollar. So all of them have been losing: the Canadian dollar, the Swiss franc, the euro, the pound, the yen, the New Zealand dollar, and the Australian dollar. So this is easy to interpret that the dollar has been pretty strong against these other currencies, and the ones that have been resilient, good Canadian dollar and Swiss franc, whereas the ones that have been the New Zealand dollar and the Australian dollar. So if you look at year to date, this is from the beginning of the year, then it's still the same story, but now there's a switch. It's actually the Japanese yen that has been losing against the dollar the most compared to these other currencies. So out of the analysis we have done, we can easily identify the dollar is currently very strong as a result of the monetary policy, and the Japanese yen is currently very weak. So if you look at the daily, and this is today, the Japanese yen is the only one that has slightly gained against the dollar, whereas the pound has been losing against the dollar, the biggest. Swiss franc, Australian dollar, euro, Canadian dollar, and New Zealand dollar. If you look at this week, same case, so the dollar remains king, and Australian dollar seems to be the one which have taken the biggest hit. So New Zealand dollar made some good improvement for the week, especially after hiking interest rates by 50 basis points. So now that you have an idea of what to look for in the markets, I think it's a good time to now jump in and look at the charts and see what they are saying. So if you have any questions or comments, feel free to type that in the right comment section, and I'll be responding to that right away. So hello, Francis, and welcome to the session. So our target currency out of the analysis we have done today remains the USD JPY pair. And clearly, you can see it has been on a bullish trend. So this is on the 1 hour chart. So it references the past couple of weeks, I would say 4 or 5 weeks. And it's very, very interesting that the US dollar remains strong and keeps on pushing higher. But then there seems to be a wall that is acting as resistance here. If I remove all this noise. And now we focus on the most recent price action. Then you can see that there's something that is clearly happening around this area. So there is some form of triangle that is forming this chart. So if I was to expand my triangle here, so I'm basically saying there's a trend line, one marking the resistance here, and another one marking the support areas here. So we are looking at a price level around this area here. So the market has been oscillating this way, and there's a very strong wall of resistance here. So every time the market pulls back to now this lower trend line, and if we scale back, you can see that the lower trend line has been holding well since the bottom that we saw somewhere around the 2nd of February. Then the market keeps on bouncing around this area. Every time it gets back the lower trend line, tends to bounce off very well. And it seems something similar is happening right now. The price action of the last candlestick indicating the rejection of our prices. So from a higher time frame, which is the daily time frame, you can see that the huge divergence between the two central banks led to a big shift in the exchange rate of the currency with over 30% change. This is dating from December 2021 to around October last year. So this was a 34% gain in the currency before investors took profit. So the Bank of Japan intervened in the currency market to try and support the Japanese yen. So after the intervention, we saw this exchange rate drop all the way down by around 16% before bottoming out. And now, since the bottoming, we are seeing the market start to pull off higher, forming higher lows, and at the same time, it's forming significantly higher highs. So now we are looking at a whole new year of trading, And in this year, as long as the Bank of Japan remains with the current policy and the Fed keeps hiking interest rates, then the expectation is that the previous trend of last year continues. So a bullish trend, a pullback, and then some form of continuation. So unless the Bank of Japan decides to intervene in the currency market, then the overall idea is that this price will continue running higher. So as a forex trader, you know that the fundamental analysis basically gives you an edge by telling you the highest probability that the exchange rate will take. In this case, the probability is towards the upper side. So now that we understand the probability is towards the upper side, you still have the technicals and find the most critical technical price patterns. So for instance, look at the last time the market visited this particular trend line, you can see that there was a key level support that was being tested several times. I think this is clear for everyone. So market was going back down, found support, second time at that time. Then on the fourth day, there was a quick liquidity grab and then a bounce and a very strong rally. So market retested the trend line again here and bounced, retested, kept going up. Then we entered this form of triangle or almost sideways momentum, where you can say that on average, from this day, price has just been going this way, and this is not a very clear trend. It's a very slight bullish momentum. So the expectation is that we'll be seeing some further upside. So the idea is to look for when the price is oversold so that you can strike bullish positions. So I think that was pretty comprehensive for today. If you have any questions related to the presentation, feel free to type in the live comment section and I'll be responding to that right away. So there's a question about gold from Trapskid. I hope it's the right pronunciation. So we look at that before we end the presentation. So gold is one of the assets I've been following closely. Currently, bearish trend, bearish momentum. So we can see that the bearish momentum began somewhere around here from a high of around 1959. And this was not a distant past. This was the 2nd of this month. So for the entire February, we have seen gold erase all the gains it had made in January. So remember, gold started the year very strong. So, the 1st of January was around here. So made a very strong rally all the way up. And then at the beginning of this month, there was a very sharp drop. And this is when investors realized that things are changing. The Fed is not going to stop hiking interest rates. And the dollar started strengthening. So when the dollar started strengthening, gold started weakening. And as a result, we have seen this particular pattern in the market. And this pattern is expected to continue going further downwards. However, from a technical perspective, I was expecting this to hold. So when the market got to this support and bounce, and then got close enough and bounced again, then I was expecting that either the market will break that level outright, or there will be a liquidity grab in the market. So in the previous 4 hours, we saw the liquidity grab happening here. Market going up slightly, didn't quite get to rally, and then continuing to drop further downwards. So if there's a clear break of this particular support at 1818, then the idea is that the dollar continues strengthening and gold continues losing all the way down towards the lower trend line. So potentially getting to even the 1800 price. So 1800 would be in the books if this particular trend continues. So as for now, if we happen to see the dollar taking some short-term weakness, then we'll rally and retest the upper trend line here, and this could be a potential intraday trade. However, the prevailing conditions of the potential of a strong rate hike indicate some further downside pressure on gold, and gold being treated as a risk asset, similar to Bitcoin and US indices, then we'll be expecting some form of correlation. So SP 500 making a very sharp drop, getting to the lower trend line here. So from the forward chart, you can see there was a very strong rise. Let's use the daily to get a clear perspective. So we saw SP 500 breaking this particular level. It had started forming higher lows. So from this low that we saw here and this low, it was indicative of a bullish momentum. We saw higher highs. From this high to this high, it was getting higher. But now, the current price action, we are seeing the S&P 500 attempt to break this level, and it's basically the market getting back to a sense of reality that the Fed will continue hiking interest rates, and this has the overall effect of weakening equities and strengthening the dollar. So, fourth straight week, where the Dow is also rising. So this week, last week, the other week, and this other week. So this was a major sideways and then a very sharp drop. So from the daily chart, you can see we are headed back the previous trend that we had last year. So same case for the US Tech 100. So from the daily chart, this is the price action of last year, and then a slight break this year when out of tech stocks made record gains. I remember seeing Tesla up 69%. Then from here, you can see for this week, it was a gain. So this is for the first week, second, and now this is the third straight week. We are seeing some further downside momentum happening in US equities. So thank you very much, guys. Thank you for your time. I hope there's no question we have not answered. Pound USD. So we expect a similar reaction to happen from the Bank of England. So whereas there's a clear trend or trend expectation happening between the US dollar and Japanese yen, between the New Zealand dollar and Japanese yen, then for pound USD, it's not very clear. So that may explain why we are seeing out of sideways momentum. So from this area here, I would say, let me just clear my chart. Screen, yes, proper one. So I would say that for this particular period here, or in summary, for the entire month of February, I would say the price was not largely moving in a trendy manner. I would say the price is moving sideways. So the idea is now to look at which central bank is more aggressive with rate hikes, try and identify a direction. So this might remain very technical for this quarter, especially since traders will have to depend on intraday or intra-week news in order to react to the direction that the market is taking. So as per now, it seems that the market is on a downswing. So the expectation is that the price keeps on shooting lower as long as the dollar remains strong. So the current support seems to be around this area, 1.193. So if it manages to break this area here, then the 1.193 becomes a reality. So if I mark this area here, this is a support, the support. So the market is currently testing here. So if we break, then we go to this other one at around 1.193. So thank you very much, guys. Thank you for your time, and I hope to see you on the next session.